Welcome to the Wealthwise Show, where financial wisdom meets the road to prosperity. Get ready to embark on a journey to make wise financial decisions and unlock the secrets to building lasting wealth. I'm your host, the Wise Investor, and just as a disclaimer, I'll go get some compliance out the way. This podcast is intended for educational purposes only. It is not intended to be tailored personal advice because I don't give personal advice on the internet. So keep that in mind as you continue to listen to this podcast. That is for educational purposes only. And if you hear a product like a service or a company, anything like that, I'm not endorsing them unless they're sponsoring the show. Well, then it's an endorsement. So just keep that in mind as you get into today's episode of the Wealthwise Show. Alrighty, guys. Time for another episode of the Wealthwise Show. I greatly appreciate you guys. This is episode 15. I'll just get some, I forget what it's called, compliance out of the way. We're going to restart this. Actually, I'm not going to restart this. Yeah. I'm not going to restart this. Anywho, let's keep it rolling. Compliance, guys. Financial advice, not given here. I don't give financial advice, nor do I offer tailored advice. So please don't act on anything I'm saying because it's not tailored to you, because I don't know you unless I do know you, and you should call me. But yes, this is not advice. This is for educational purposes only. I don't give advice on the internet. And if you want me to give you advice, become my client. If you want to find out how to become my client, I don't know how to do that. I got to talk to compliance to see if I can even offer that to you guys. But anywho, back to what I was saying. That out of the way. Do your own research. Go talk to your professionals, fiduciaries, and things like that. Today, episode 15 episodes in. That's 15 weeks. 15 weeks of hearing my voice. Wow. I never thought. But let's talk about investing. So, what are the basics of investing? Let's go back to the basics. I like that. And one of the reasons why I want to talk about going back to the basics of investing, because people seem to put the cart before the horse. Matter of fact, they do more than just put the cart before their horse. They do everything but get a horse. So I want us to go back and go to the horse dealer and find a class steed to get us from point A to point B and back to point A if necessary. And, of course, have the cart. But the reason why, like I was saying, because a lot of people, they go straight to options, they go straight to futures, they go straight to risky assets, and they're drowning in debt. They can't afford the things they're investing in. They're investing on margin, which is nothing wrong with investing on margin. But if you don't know what you're doing, you don't know what margin is, then, you probably shouldn't be doing it. It's a little too risky. So as the wise investor, I want to impart some wisdom today about the basics of investments. And I'm going to give you the order on from risk, super safe, cash preservation to cash annihilation. So we're going to go with the safe to the less safe to the minimum risk to risky to you better know what you're doing kind of risk. So let's go into the dynamics and nature of the investment landscape. There's multiple ways you can invest. Investing is essentially allowing the earned money that you earn make more money. It's pretty simple. And there's different ways you can invest. There are different levels of investing. There are different risk levels as well associated with those levels. We have something that's called the investment ladder. Now, keep in mind, a lot of these points I did get from Investopedia, so just wanted to cite any sources. If I do have sources, not have sources, if I quote something, that's where I got it from. But the investment risk ladder. What is the investment risk ladder? Well, you start at the bottom where it's, pretty safe, pretty easy. And as you go up that ladder, You go 5 feet, 10 feet, 15 feet, and you start like, whew, it's pretty one wrong move, and that's it. So that's why that analogy fits when it comes to investment, because there's many different classes and categories. The safest option is cash. Why is cash the safest option? Because it's not doing nothing. If I have $1 and I'm holding on to that dollar and it's in my pocket, it's gonna stay in my pocket. Unless the only risk I have by holding that dollar in my pocket is if I wash my clothes. And even then, the dollar should be fine when dry it off and all that stuff. It's still spendable. So that's why holding cash is one of the safest ways. But the issue with holding cash is, let's say, you have your income set and you have a little money to invest, and it's just sitting there in cash. Guess what it's doing? Nothing. It's earning you nothing. It's being a useless employee. So if you have $1, kind of view it as your business, like your employees. So for every dollar is one employee, and every employee has their role to play. So if I have $1 and I say, hey, you gonna stay here because I might need you. That's gonna be my call-in employee, the people that's on standby. Then I have another dollar. I'm like, hey man, I need you to go out and fix this problem in my house. And that's an employee, you're going to spendable. Then I'm going to have some employees say, hey man, I need y'all to stay in this house and work on this house so I can have a better house. That's going to be your, I would say, investment type things when it comes to cash. So everything revolves around cash when it comes to investing, because that is the source of investments. It's cash. Of course, you got time, investing your time, but I'm not on that train today. I'm talking about investments here. So when you have cash, it's safe, but it's not doing anything. So let's move on to the next thing. Let's say you do want to do something with your cash. Well, what is the next asset besides cash? That's not just safety. Well, you got low risk cash preservation assets that produce interest. You got your CDs, your savings accounts, your high yield savings accounts, you got your bonds, you got your preferred stock. Oh, another word that people don't really talk about in this financial space. Preferred stock. What is that? Oh, that's for another episode. Anywho, you got these things where they're going to be paying you some interest, but it's not a lot of interest because there's no real risk. So the more risk you take, the more potential for gains and potential for losses. The less risk you take, the more potential for less losses and less gains. So it's simply that simple. And then the next one is going to be your mutual funds. So mutual funds is, I've talked about it in one of the episodes, mutual funds are ETFs. So you guys know what mutual funds are. But it's basically, a portfolio manager has all your money and everyone else's money, and they're investing it for you. And typically they have a diverse investment approach. So low risk, because you have someone who's professional managing your money. Your next one is going to be your exchange traded funds, which is similar to mutual funds, but you can buy them on an exchange. So your ETFs, and ETFs are very similar to mutual funds, like I said before, but they're easy to get in and out of, and because they are based on supply and demand, meaning they have share prices that can fluctuate. There's an ETF, there's tons of ETFs that are, probably have some of the best money managers in the world, but they can't, if you own that shares of that ETF, it can tank along with the market. And so that's why it's a little more riskier than mutual funds, because mutual funds have a set NAV, net asset value. I don't want to get too much into that because then you're going to have to make me take out my Series 65 book. But just know it's not like a ETF where it's not fluctuating as much. It's not as volatile. There you go. And then you got your stocks, your individual stocks. You got your companies, your Fortune 500 companies, your small cap, your large cap, your mid cap, your no cap. What? No cap. And you got all these different, um, you know, different companies who, when you invest in them, the value of your investment is determined by their business. So let's say there was a company I will not name in 2020, 2021, and they lied to investors. They were IPO through a SPAC, which I'm not going to get into neither. I'm saying a lot of new words, but there's a reason I'm saying a lot of new words, but that's for a later episode. SPAC, and people fell for the okie doke. And what happened? It was all a lie. It was all a sham. The product that they were touting as revolutionary and, first in class, well, that product was a lie. So investors lost a lot of money. See, that's the risk of having individual names. So I went from cash to bonds and, interest income drivers, mutual funds, ETFs, and then stocks. That's not it. There's another asset class that people don't talk about much. And I'm going to say a word, and it's going to sound similar to what I just talked about, but they're different. There's alternative assets, alternative investments. So alternative investments is vast. So they pretty much don't fit in the categories I just said because they're typically tangible assets. Stocks are no longer tangible. They can be. You got to pay for them. So you want some stock certificates, you can purchase those. But, typically they're not going to be tangible. There's all in the data, in the matrix. So you got your real estate. It's a tangible asset, but it's also an investment vehicle. So that's why they say alternative. You got hedge funds. Now, that's the word I was talking about. You might say, well, you literally just said something about mutual funds. Now you're talking about hedge funds? Well, what are hedge funds? Well, hedge funds is pretty much, they're not really regulated. I mean, they're regulated. I shouldn't say they're not. Hold on. They are regulated. But what I'm saying is they are not investment companies. So a ETF and a mutual fund are considered investment companies, meaning they got to get all these licensings and all this approvals and all that stuff. Hedge funds don't really have all that. There's just basically a bunch of people, with a bunch of money together, and they're investing. So that's why it's on the risky side, because, it's not considered an investment company. It's not like as strict as it would be if you had an ETF or a mutual fund. Then you got private equity. Private equities, private companies and things like that. Companies are not IPO'd and all that good stuff. And then you got commodities, gold, silver. You're like, well, why is gold, silver, and all this stuff? Why is that super risky? Because they're tangible. And the thing about tangible assets is they're not considered liquid. Any of the things I just mentioned and these alternative assets, they're not super liquid. Meaning, if I had a stock, I can sell my stock in minutes and transfer the money over within a week. But if I had bars of gold, yeah, technically I could go to someone down the street and say, hey man, here's my bars of gold. Can you, take them off my hands for X amount of dollars? People might say, well, yeah, it's easy. Just go down the street to the We Buy Golds guy. True. But how easy that is compared to me laying in my bed saying, oh man, I need some cash for this week. Let me go ahead and go on my app really quick and put in an order to sell tomorrow. See how easier that is for me having to go find my gold bars, finding the person, asking how much they're going to charge or how much they're going to give me, put it in my car, drive to wherever they're at. They playing around and saying, hey man, I only got this much. Can you take it? And you're like, nah, that's not what we agreed on. Then you go find someone. See all the hoops you got to jump through when you're dealing with commodities and real estate and private equity. Real estate is the same. I buy a house. How long does it take you to sell a house? Oh, it takes me a month. Well, it takes me a few seconds to sell a stock. It takes me a few seconds to sell shares of an ETF. It takes me a few seconds to transfer money from one account to another with cash. So that's what I mean by liquidity. How easy is it to get the value out of this investment? And that's why that is the riskiest. So if you're working from the illiquid down to the most liquid, you're kind of doing it backwards. And the reason being is, if let's say, a lot of people are getting into the housing industry because they think it's easy. And they come to realize when you own something that's tangible, you got to give it to someone in a tangible state. And a lot of times, people they're going to, kick your tires. They're going to ask you a bunch of questions, and, it's not going to be a fun time trying to sell that tangible good. So starting with cash, now we're going to go into, a sensible investment strategy. Now keep in mind, guys, educational purposes. I'm not telling you to do this. Talk to your financial advisor. If I'm your financial advisor, talk to me anyways. Come text me, email me. Well, email me is better, and all that good stuff. So what is a sensible investment strategy? Start simple. Meaning, if you're in debt, you got a job, but you're in debt. Get out of debt. You might say, well, the master investor, that is easier said than done. I completely understand you. But that is more important than investing at the moment. And you might say, well, why is that more important than investing at the moment? Because investment comes at a risk. So let's say you are $1,000 in debt and you have $1,000 to pay off said debt, but you go and invest it in the stock market. And the stock market goes down and it keeps going down. But your debt is collecting interest, so that keeps going up. So while you're losing money, you're losing money. You're losing money 2 times as fast because the debt is increasing and the stock market is going down. Now what are you going to do? See, that is why having getting out of debt, a savings account is important to start with. This is where you start. This is not where you're going to finish. But this is something that you should think about starting with because it's going to give you that stress-free, non-desperation when it comes to times of drawdown. Like, you're going to be less stressed. So getting out of debt, and I understand everyone probably can't get out 100% of debt. I'm not talking about pay off your car, pay off your mortgage. No. I'm talking about like credit cards, little loans. I'm talking about little personal loans, nothing crazy, nothing that, you're utilizing for your assets. So paying down debt. And the thing is, if you have more than enough money to pay off your debts, all right, keep that money that you have to pay off your debts, pay it off, every month and pay a little bit on it, and the extra money invest. And there you go, because your debts are already taken care of because you have that cash reserve. So start there. Then start looking into, some, if you're depending on your age and depending on your, where you are in life, you might have a family, you might not have a family, who knows? And this is why it's important to talk to a fiduciary because I don't know you and you don't really know me. So I can't really give you advice. So that's why I say this is for educational purposes only, and do your own research and talk to someone. But if it makes sense in your life, look into some index ETFs, index funds or index ETFs, whatever floats your boat. And that way it can start building up equity in that fund or in that ETF, and you start collecting some dividends. And then once you build that equity up, start looking into income products, stuff that's going to, produce some income. So when you get older, any gaps may come up from retirement, it can be filled in, and boom. Then you start diversifying, it's important to diversify. I don't think I put out the episode, but there was an episode I made about diversification, but I was low energy that day. So I might remake it. But it's important to diversify because having cash, having, income products are, like bonds, having stocks, having ETFs, having mutual funds, having real estate, all those things are diversified. So if you have, I'm not saying you need to get all those things, and I'm saying you need to get all those things right now. If that's your goal and you're working towards it, take your time, work towards it. But having all those things is going to allow you to basically diversify your risk, because that's all you're doing. You're trying to minimize the risk, mitigate risk. And that is the key thing of being an investor. One of the top things an investor should do is always mitigate risk. So keep that in mind. And then understand and how certain asset classes work. So, if you are in bonds and bonds are going down, stocks may go up. If stocks are going down, bonds may go up. There was a time in 2022 where both bonds and stocks went down, and housing, I was at the standstill. It was still going up, but at a standstill. So diversify in different things like that where you're in cash, because cash can be considered a position. So you're in cash waiting, and your cash is saved and preserved. So understanding how the economic changes can impact the performance of your different assets is a really good way when it comes to guiding your decisions. And so that is a really important thing. And then also, like you're doing now, educating yourself. The importance of investment education is severely understood. And my bad. And unfortunately, it's a lot of stuff that out there that is really meant for taking advantage of people. So that's why I always say, when it comes down to education, you don't just have one teacher. I mean, if you ever been in a school, especially here in America, where, you only had one teacher, that's typically in first, second grade. You only have one teacher. And after a while, you grow, you learn, and you start to developing your skills as a student. And now you got multiple teachers teaching you certain things, certain subjects. So if you only have one teacher and you've been in this investing game for a while, what did that tell you? So just don't learn from one person. Learn from many different people, learn from different books, different investors. One of the books that I can mention, it's not an endorsement. I really do like this book series. I'm trying to type it in because I'm trying to see what it is. I read it a while ago, but yeah, this, reading books, listening to what you're doing now, podcasts, watching YouTube videos, trying to learn all that stuff really is going to help you make better decisions, because you can take all that knowledge and then put your own spin on it, your own twang on it, and learn from that and pretty much develop your own skills and develop your own strategies. That's basically what I did too. So you got The Intelligent Investor, which is a great book. But then you got, what is it called? I forget the name of the book. If I remember it, I'll put it in. I'll put it in the description or something. But yeah, reading these books, learning from different investors, especially those who are successful. Like you got your Ray Dalios and all that stuff. Even people like I was about to say Stanley. Oh my goodness, Warren Buffett. I was about to say Stanley. My bad, Stan. My bad, Warren. Or yeah, whatever. Okay. Anyway, learning from these different investors can really help you to see how the people who are really managing your money and really managing the markets, how they really do. Like, how are they when it comes to, emotions. Like, they're not just doing whatever because someone else said, hey, do this. Some of them do, but a lot of them don't. So that's important of financial education and investment education. So don't just follow unreliable tips. Understand consulting, a professional, consulting someone who's licensed, who job is on the line, their, livelihood is on the line, and consulting those people are really going to help you have an unbiased opinion, because some people just want you to stay with them because you're providing their yacht parties, you're providing their, vacations for their spouses and things like that, and they're not really giving you nothing in return. And so pretty much that's gonna be it. Just to summarize, guys, understand cash is important. Stocks are important, ETFs are important, mutual funds are important, bonds are important, and real estate, alternative investments are important. But understanding their place and where to put them first depends on your personal situation. And so that is important, guys. Those are the, from risky to the most, or from safe to the most risk. Also, if you're near retirement, if you haven't developed a well-balanced, diverse portfolio, talk to someone ASAP. So I appreciate you guys listening. I really think that I'm going to keep doing this. I'm already 15 episodes in, so I'm going to definitely keep doing this. But I really appreciate you guys listening to me week after week and helping me be better at speaking and be better at, helping my clients out, because this is giving me, I've started this podcast to kind of help me talk and get used to talking, as well as, if my clients ever research me, they can find this podcast and they can see, because I'm a little young, and they can see that, I know what I'm talking about. I'm not just saying whatever that someone else is saying. I've done the research, I've done the work, and sometimes people won't give you the chance to do that because they don't know you. They just see a picture and they make their own story. So I want to give them my story before they make up their own story. So I appreciate you guys listening. All the likes, the comments, the all that good stuff. I appreciate. And I found the book. It is called The Market Wizards. Thank you. So the Market Wizards books are great. And Mastering the Market Cycles are another good one. But the Market Wizard books are great because it just tells the story of the top traders, different traders, different investors, and things like that. And they're, it's a really old book, but look up Market Wizards if you get a chance. Excuse me, great book. But yeah, guys, I appreciate it. I'm going to keep pumping these out as much as I can. And until next time, guys, stay Wealthwise. Investment advisory and financial planning services offered through Simplicity Wealth and SEC Registered Investment Advisor. Sub-advisory services are provided by Simplicity Solutions, LLC, a registered investment advisor. Any insurance, consulting, and education services offered through the Wealthwise Show. The Wealthwise Show is not affiliated with Simplicity Wealth and Simplicity Solutions.